Hi everyone, Dave Barnett. This is our second part of our banking webinar series. So we talked about what's happening in the banking industry and we talked about what caused it. Now we're going to talk about how this is similar or different from the financial crisis of 08-09. In some ways it's similar because if you look at some of the big investment banks that went down in 08 and 09, they were extremely concentrated. And if you look at SVP, it was concentrated as well, particularly with tech companies on providing the bulk of its deposits. But in some ways it's very different. Asset quality in 08-09, in terms of just the toxic real estate securities that were on investment bank balance sheets, led to that crisis. This time around, it was really interest rate hikes that led to an erosion of the value of fixed income securities. So it was an asset quality issue on both ends, but it was much more of a speculative asset play with the real estate than it was with mortgage-backed securities this time around. I think this time around, you just have to attribute it to it was a breakdown in basic banking fundamentals. I think in general, banks are much stronger this time, but even though they're stronger on paper, doesn't mean that they're stronger in terms of thought process and in terms of management. You need to have a high quality management team running a bank. They need to be focused on the right things, and they need to kind of focus on only those things that will underpin the safety and soundness of their institution, and they need to ignore everything else. So what should you do, and how can you avoid some of the problems that depositors at Silicon Valley Bank and Signature Bank have gotten caught up in? Well, I think that you should do due diligence on your bank. What do I mean by that? Ask the bank for the financial statements or go to Yahoo Finance and look at it and see what they have in terms of unrealized losses lurking on their balance sheet. Look at what their capital adequacy is. Look at their debt to equity ratio. Look at their balance sheet ratios. Do some due diligence to get comfort and see how they comp against their peers. It's a very positive thing to do. You want to make sure that you also want to look at the quality of the management of the bank. You want people that have been through multiple down cycles in banking who have a really strong gut feel. I mean, a lot of people have the information and they have a lot of analysis, but you need to have a bank. If a bank that's going to be successful is somebody that's heading it, who can see around the corners and understand what's likely coming ahead in the cycle. Those are the people that you want to be with, not people that are just following rules, but people that have proven through the past cycles that they're survivors and they know what's coming. You also want to look at a bank and make sure that the bank is only focused on issues pertaining to safety and soundness. If the bank is getting a little political, if the bank is getting a little socially active, I would avoid it, because frankly, if they have the time to do that, that's time that could be spent on ensuring that the bank is safe and sound, which is what banking should all be about. And then what I would also look for is that, much like if you look at some of the banks, investment banks that fell in 08-09 and the banks that have fallen here, they were concentrated, over-concentrated, whether it was real estate, whether it was crypto, whether it was toxic securities, and you want to make sure that your bank is diverse and broad-based. So I think if you do a little bit of diligence, you look for the grizzled veterans who are leaders in their industry, and then if you also avoid banks that are talking about anything not pertaining to safety and soundness, I think you'll find yourself a good bank, and I think you'll be safe from any market turbulence that's coming your way. Thank you.